Hey everybody, Chuck Gibson from Financial Perspectives. Let's kick this month's video off by taking a quick look at the quarterly performance report. The one thing that should jump out at you that has not been seen in a long time, and that is U.S. stock underperformance. The Dow Jones Industrials are down slightly for the year, while the broader S&P 500 index eked out a small gain. This is against the backdrop of a good to excellent returns during the same period of time for EFA and the emerging market countries. Now, I realize that one quarter does not make a trend, but I have been concerned that the U.S.-centric investment thesis that has presided over the markets these past 2 to 3 years will eventually end. With U.S. equities richly priced as compared to historical norms, and EFA and the emerging markets at the frugal end, the case can be made to make some room in your portfolio for some diversification outside the U.S. if you have not already done so. We heeded this advice and began to stick our toes into the strongest of the foreign markets, adding 2 positions, one in Germany and the other in China. Moving on to a weekly look at the S&P 500 index chart. Clearly this chart is representative of a stock market in a strong bull uptrend. You can see the rising wedge I've drawn here in black that has developed over the past 6 months. These are typically identified as bearish reversal patterns, but don't have such great statistical probabilities associated with them. So while that fact may cause some to ignore its warning, this one comes with negative momentum divergence, which increases the probability correction will occur. In this case, if the pattern does in fact play out, its projected target is in the neighborhood of the prior 1820 low made in October of last year, which is an 11% drop from where we closed out Q1. Any correction, at least as of now, would be viewed as a normal consolidative correction within the context of a bull market. In the next chart, looking at U.S. sector performance, healthcare and consumer cyclicals were the clear winners, reflecting investors who seem to be repositioning into more defensive equity positions. Utilities were hit hardest, impacted due to the short-term bond yield bounce that occurred during the quarter. In the next chart of the U.S. dollar, you can see it continued its parabolic rise, creating a massively overbought condition in the upper pane RSI momentum indicator. This is neither healthy nor sustainable, and as such I'm expecting a pullback, which would both unwind overbought condition and change the trajectory of the rise to something more reasonable. If this were to happen, I do not believe it would be the end of the uptrend, rather just a corrective, healthy pause from which to begin a new push higher. A long-term look at the U.S. 30-year Treasury bond shows a chart that mirrors the previous U.S. dollar chart. Back at the start of 2014, when most analysts were calling for the end of U.S. bond market because rates were going to go higher, the charts were telling a different story. Since that identified Golden Cross breakout buy on the chart, U.S. long bonds have outperformed stocks. While the chart looks very strong, I still have 2 concerns. One, we're approaching a blue upper channel which has acted as resistance so many times in the past and may do so again. And 2, again, a divergence issue comes up. This time we have negative divergence, which on a weekly chart is rare and should not be ignored. This is where a prudent investor would be looking to book partial profits if they have not already done so. Since there is no liquid 30-year Treasury investment, our preferred vehicle to use in order to gain exposure to the long end of the U.S. Treasury bond market is shown in my next chart, TLT. After the corrective consolidation from mid-2012 to the beginning of 2014, TLT has been on a tear, rising almost 35% trough to peak, and that's in just 13 months. Other than the massively overbought condition, there is nothing in this chart telling us to step aside. Once it broke out above the 30-week moving average back in early 2013, it has hugged that blue support line the entire time. Until either we fall below the moving average or the blue uptrend support line, TLT is still a place I want to be invested. In past reports, I have ignored commodities because they have been in one extremely ugly downtrend since their post-Great Recession recovery high back in early 2011. Since that time, you can see the CRB index has fallen almost 45% as deflationary and dollar strength pressures have been having their way with commodity prices. Why I decided to show this chart now is because of 2 important signals indicating a change may be afoot. Firstly, we are approaching a 10-year, very important low level of support that we last touched back in 2009 at around the level of 200. one would normally look for not only support, but also a reflexive bounce higher right here. And two, the most recent low in March created positive divergence in the momentum indicator. This is exactly what a long-term investor would look for as a place to consider taking an initial position. But being completely honest here, the chart is telling me to be a buyer, but in my mind, I know that until the dollar backs off from its parabolic run, remember, commodity and the dollar tend to move inversely, I don't see how a move higher would have enough strength to provide a worthwhile upside reward. So I wait patiently for more evidence, stalking an optimal entry point. In this next chart, I'm again presenting something new as we look for attractive alternatives to U.S. equities. In spite of the recent feebleness of the euro, European and Far Eastern stocks are looking more and more attractive, especially on a relative basis to U.S. stocks. This chart of EFA shows a market that was in a strong uptrend until mid-2014, when it began its corrective consolidation. Notice how it both broke the blue uptrend support line and the 30-week moving average, the solid purple line, in and around the same time. If we were in this position, and we weren't, this would have been our signal to sell. Its 15% 7-month long correction and subsequent breakout is now signaling we should expect to see new highs in the future. In addition, if you look at the bottom pane, which shows a ratio of the performance of EFA against that of the S&P 500, it's pretty obvious that even though the price of EFA was rising, it was underperforming the S&P 500, so there was no reason to own it. But notice how that all changed at the beginning of 2015, where the ratio bottomed has since begun its recovery higher, reflecting outperformance and a reason to considering adding this to your portfolio. As an educational note, it's important to remember that it's not just about making sure you're in a rising market, but also make sure you take a look at how it's performing against other rising market alternatives. To close out this month's video, I wanted to remind everyone of the significance of reversion to the mean in investing and the fact that U.S. stocks have not had a mid-teens percentage pullback in years. That combined with an overbought dollar and bearish wedges on broader U.S. market indexes have created a confluence of indicators warning of the potential for a pullback. As I stated in last week's blog post, it is my opinion it is not the time to become a hero by adding exposure to U.S. equities right here. The timing is right, though, to either reduce or shift risks and assume a more diversified approach. The last chart that is showing on your screen right now is that of the same EFA chart from before, but without any annotation other than I have drawn in one pattern, a rising wedge. What I'm hoping to point out is that the EFA chart may be giving us a roadmap as to what may lay ahead in the very near term for the U.S. market. They saw a breakdown of the rising wedge, which turned into a mid-teens percentage correction, and then a resumption of the bull market, which is now on track to make new highs. This is my favored scenario for the U.S. stock market. We all know the markets may not repeat, but they do rhyme. Thanks for listening, and I look forward to being back here with you next month. This has been Chuck Gibson from Financial Perspectives.